Good afternoon. My name is Hyeon-Wook from the KDI. Today we talked about the systemic risk and macroprudential regulations. I think we can think about systemic risk as in a two dimension. I mean concentration risk in a two dimension. The first is concentration risk in a cross-section dimension, which is related to the systemic risk that Professor Acharya tried to measure in this morning, and issues related to the too big to fail risk and too connected to fail risk is in the same vein. And also there is another risk, another concentration risk in the time series dimension. We can say the example of that kind of risk is pro-cyclicality risk. That's one I want to cover in this presentation. Actually, there are so many economic phenomena or social phenomena we can watch or we can see. Something is highly concentrated to something. For example, the last name of Korea is highly concentrated to last name as Kim's. So, and this paper, my name is Kim and my co-author's name is also Kim, and it's quite concentrated to last name Kim's. And today there are 6 presenters and discussants whose name is Kim's, including the governor of the FSS in Korea. And there are another 2 Kims tomorrow. There are 8 Kims in this conference, but nobody says that it's a really dangerous risk. So we can say that we don't have to, regulate or control all the concentration, but we have to identify what's the risk inside of the concentration. That's a kind of thing I want to say in this presentation. Let me go back to the formal presentation. Oops. Oh. After the recent global crisis, so many attention has been refocused on the negative effects of the pro-cyclicality, which is one of the concentration risk in the time series dimension. And then, many prescriptions has been proposed to deal with or to reduce or mitigate the pro-cyclicality problems. Those prescriptions can be categorized in 3 groups. The first, the revision of the Basel II capital requirement system, and the second group can be called as creating a new capital adequacy framework or creating a new system, including dynamic provisioning, which I just covered in the previous presentation. And third can be named as penalizing large banks with a high risk of funding, something like regulating the CFIs, significantly important financial institutions, and so far. Oops. So let me just briefly go over all these proposals to mitigate the pro-cyclicality. The first one, the revision of Basel II capital requirement system has been proposal with most popularly proposed even before the recent crisis. The idea is that reducing the risk sensitivity of the Basel II we can have reduced counter-cyclical counter-cyclicality of required capital, and then we can mitigate pro-cyclicality of the bank lending. But it has been already criticized that the essential purpose of the Basel II would be tarnished, since it is going to be very difficult to monitor the risks that the bank face in time, at a certain point of time. So we may have to sacrifice the efficiency of the capital allocation between the banks or between the banking system and others. The second, the creating a new capital adequacy framework includes the capital buffer argument and also dynamic provisioning. The idea is by forcing banks to hold additional capital, additional pro-cyclical capital buffer, we can allow banks' capital to be non-binding, so we can mitigate the risk sensitivity of the fluctuations of the bank capital. Actually, this is kind of similar to smoothing the output of the Basel II. So this is one kind of branch of the method of mitigating pro-cyclicality, which can be incorporated to the revision of the Basel II regulatory framework. However, there is also critique that at the arrival of the crisis, no reasonable capital buffer can restore the confidence anyway, and bank will still want to reduce the loans and raise their capital ratio. The third one, the finalizing the large banks with a high risk of funding. Actually, the large banks is a kind of usual suspect whenever there is crisis, and this time is not different. I mean, this time also, many people want to accuse the large banks, large financial institutions, and to regulate them in a certain with a certain measure of the regulations. Actually, this is actually those proposals are aiming at the reducing systemic risk rather than the pro-cyclicality problem. But the people want to make this kind of regulation. Argue that there is a byproduct effect for the reducing the pro-cyclicality in the bank lending. For example, capital insurance mechanism or mitigating leverage ratio or strengthening regulations on CFIs are those in the same vein. So the motivation is like this. Almost all the regulatory proposals are asserted to contribute to resolving mitigating the pro-cyclicality problem. However, we need to consider that it may be excessive if we adopt all the regulations proposed. So we have to select some of these proposals to be developed as a future regulatory framework if we want to be efficient and to want to get a balance between the efficiency and the safety of the whole financial system. So in the IMF's Global Financial Stability Report, somebody had also made also same concerns about this kind of problem. In other words, we have to ensure that the combination of measures strikes the fair balance between the safety of the financial system and its innovativeness and efficiency whenever we are moving forward to the new regulatory framework. Then the question is, what kind of regulations can we suggest as the most adequate for Korean financial system to mitigate the pro-cyclicality problems? Before to the main topic of that, I want to give some overview of pro-cyclicality in the Korean financial system in the figure 1 and so on. In the Korean financial system, most of the non-financial private sector, financial claims to the non-financial private sector consist of the loans. And reflecting the underdeveloped bond market in Korea, there is a relatively small amount of the securities, and also derivative products almost negligible portion consists. The derivative products are almost negligible in the Korean financial system. And among the loans, most of the loans are from the deposit taking institutions, including banks, which can be easily expected. And then, if we compare the GDP growth rate and loan growth rate in Korea, you can see there is a kind of symptom of the pro-cyclicality, but has a little bit of the legs. So to watch the pro-cyclicality and legs of the pro-cyclicality in Korea, I calculated a cross-correlation between GDP and bank loans, and we can see that the most significantly high correlation can be shown in the two legs. Two legs after the GDP moves. But if we partitioned the periods, the first period, first half of the year 2000, the 2000, and the second half of the 2000, we can compare that. We can find that the pro-cyclicality has been expanded in the later part of the last decades. And then, if we wanted to see whether this expansion of the pro-cyclicality is due to the large banks, the usual suspect of the crisis, but we couldn't find difference in the second half of the last decades. Cross correlation between GDP and bank loans in the large banks and small banks. So in the first half of the last decades, there has been some kind of differences between large banks and small banks. But in the second half of the last decades, there has been an expanded pro-cyclicality, but we cannot find any significant difference between the large banks and small banks in Korea. And then we wanted to think of cross correlation, because cross correlation is a kind of number normalized by the standard deviation of each cities. So it might be not proper to use when we want to compare, large banks and small banks cross correlation with the GDP growth rate. So we calculated cross covariance between GDP and bank loans in Korea, but in the first half of the last decade, we have similar picture that we had in the figure 6. But in the second part of the last decades, we have somewhat different pictures. The cross covariance of large banks was a little bigger, kind of significantly bigger than the small banks. So maybe we can see this. We can say that the large expansion of enlargement of pro-cyclicality of bank loans in Korea is due to the large banks. But this is just kind of simple, picture. So and this kind of similarity and the differences can be due to the another factors which determines the lending behavior of the banks. So we proceeded to to the some kind of simple regressions using panel data of 13 Korean banks from year 2000 to 2009. So in this table, table 1, we found that there is a supporting kind of evidence about the existence of pro-cyclicality of bank lending with at least one quarter of lags. But we cannot find any significant evidence that there is a different effect of the dummies indicating which one is the large banks and which one is small banks. So we cannot say that the large banks are the main, the pro-cyclicality of the large banks, the main reason of the, enlargement of the pro-cyclicality in the last decades. And third finding in this table is that the capital, BI's capital ratios are negatively related to their loan growth rates, which we can say that the more counter-cyclical buffer capital, buffer capital regulation can be effective in Korean case. And then we wanted to move to the to examine the pro-cyclicality of the bank capital, to examine the possibility of the implementing additional capital requirements such as the capital buffer. Thank you. We find that the dummy indicating the expansionary phase has a significantly estimated coefficients. So we can say that the Korean banks are already having a pro-cyclical capital buffer or capital accumulating behavior. So even though banks, even though the bank capital buffer regulation can be effective, that means we may need, the Korean supervisory authority may need much stronger capital buffer regulations. So these are the findings in our paper, and then to